In 2025, Philippine Airlines is pulling off a head-turning feat. The company that declared bankruptcy just a few years ago is suddenly outspending its rivals on new planes and routes. It's ordering cutting-edge Airbus A350-1000 jets and expanding flights, all while many other airlines are still buried under mountains of debt. How on earth is this possible? How can an airline that was on the brink of collapse now afford a shopping spree that its competitors can only dream of? This puzzling turnaround is more than just good luck or a post-pandemic travel boom. The answer lies hidden in plain sight, on Philippine Airlines' post-bankruptcy balance sheet. After a dramatic Chapter 11 restructuring, Philippine Airlines emerged with far less debt and a lot more breathing room than its peers. Every great comeback story starts with a low point. For Philippine Airlines, that low point was 2020. As COVID-19 spread, global travel ground to a halt. Borders closed, passenger demand evaporated, and aircraft that once crisscrossed the Pacific were suddenly parked in storage. The Philippines imposed some of Asia's strictest travel restrictions, and Philippine Airlines' revenue collapsed virtually overnight. The airline, a proud 80-year-old flag carrier, was bleeding cash. By late 2020, Philippine Airlines was losing an estimated 200 million pesos per day, an unsustainable burn rate that rapidly drained its liquidity. By 2021, Philippine Airlines was on the brink of financial ruin. The company had already been struggling with losses even before the pandemic, but COVID pushed it over the edge. It cancelled dozens of routes, cut thousands of jobs, and grounded much of its fleet. Yet the debt and aircraft lease obligations accumulated over years still had to be paid. With scant revenue coming in, Philippine Airlines management faced an existential crisis: keep piling on high-interest emergency loans like many competitors were doing, or take a more drastic measure. In September 2021, Philippine Airlines leaders made a bold decision. They filed for Chapter 11 bankruptcy protection in the United States. It was a surprising move. After all, this is Asia's first commercial airline, not an American company. But US Chapter 11 offered a structured way to freeze the bills, reorganize the company's finances, and shed massive debts. The filing revealed a plan to cut fleet size by 25% and eliminate around $2 billion in borrowings. To keep the lights on during the process, Philippine Airlines' majority shareholder, the conglomerate owned by billionaire Lucio Tan, agreed to inject fresh money: $505 million in equity and debt financing, along with another $150 million from new private investors. This was essentially a lifeline to carry the airline through bankruptcy and out the other side. For the rest of 2021, Philippine Airlines operated under court supervision as it negotiated with creditors. Planes kept flying on a limited schedule, but behind the scenes, the airline was renegotiating aircraft leases, cutting deals with suppliers, and restructuring debt. It even returned some aircraft to lessors to trim the fleet and save costs. Eventually, 9 aircraft exited the fleet in 2021 as part of the downsizing. By late 2021, the outlines of a rescue emerged. Creditors big and small, from jet engine makers like Rolls-Royce to maintenance providers, agreed to forgive a huge portion of what Philippine Airlines owed. It wasn't charity, it was a calculated choice. Creditors figured that accepting some losses through restructuring was better than seeing Philippine Airlines liquidated entirely. In fact, the reorganization plan won 100% approval from the votes cast by Philippine Airlines' key lenders and lessors, a remarkable show of support that smoothed the path to exit bankruptcy quickly. What exactly is Chapter 11, and how did a foreign airline use it to engineer this comeback? Chapter 11 is a part of the US bankruptcy code that allows a company to reorganize under court supervision rather than shut down completely. Think of it as a legal timeout. When a company files Chapter 11, it gets breathing space from its creditors. Lawsuits are paused, and debt payments can be put on hold. The company's management usually stays in control, unlike some bankruptcies where a receiver takes over, but their big decisions need court approval. The goal is to come up with a plan of reorganization, basically a blueprint for how the company will reduce its debts, pay back some portion of what it owes, and emerge as a viable business. For an airline like Philippine Airlines, Chapter 11 offered several powerful tools. Debt reduction. Philippine Airlines used the process to permanently slash over $2 billion from its balance sheet. This was done by converting some debt into equity. In other words, creditors agreed to accept stock in the reorganized Philippine Airlines instead of cash, and outright forgiving other obligations. Billions in loans and unpaid lease bills were wiped out with the stroke of a judge's pen. Imagine suddenly erasing 2/3 of your personal debts. That's what Philippine Airlines achieved. Lease and contract negotiation. Under Chapter 11, companies can renegotiate or even exit contracts that are too expensive. Philippine Airlines consensually contracted its fleet by 25%, meaning it returned a number of aircraft and got out of high-cost leases. Planes that were not needed or unaffordable were handed back to lessors, with the court's blessing, without the usual penalties. Remaining leases were restructured for better terms, lower rents, or extended payment schedules. Similarly, Philippine Airlines could renegotiate rates with suppliers and service providers, from catering companies to maintenance shops, to get cost savings. New financing with court approval. Bankruptcy can actually help a company raise money. Philippine Airlines' Chapter 11 plan included $505 million in new equity debt investment from its majority owner. The court approved this DIP financing, debtor in possession financing, which gives new lenders priority for repayment. Essentially, it's like giving rescue investors a super senior status. They'll get paid back first, so they feel safer lending money. Philippine Airlines also lined up an option for $150 million additional financing from new investors if needed. This fresh liquidity was critical to keep operations running and fund the restructuring process. Single forum for all creditors. For a global airline, having one court, in New York, oversee the restructuring is hugely efficient. Philippine Airlines had creditors all over the world. US Chapter 11 has a well-established process that binds all creditors to the final plan, as long as the required majorities vote for it. Even though Philippine Airlines is a Philippine company, it qualified to file in the US, partly because many of its airplanes and loans were tied to US entities or dollars. The Philippine courts also recognized the US proceedings, so that the Chapter 11 outcome would be honored back home, a first in Philippine legal history. In short, Chapter 11 gave Philippine Airlines a global platform to resolve a global problem. To put it simply, Chapter 11 allowed Philippine Airlines to shed weight like a crash diet. Debts that would have taken decades to repay were largely erased. Painful cuts, like reducing the fleet and workforce, were made swiftly, but in a controlled way. By December 31, 2021, just shy of 4 months after filing, Philippine Airlines had completed this whirlwind reorganization. That speed is astonishing, possibly the fastest airline Chapter 11 ever. Many other airlines that filed during the pandemic, for example some in Latin America, took a year or two to get through their bankruptcies. Philippine Airlines did it in a fraction of that time. When the US Bankruptcy Court approved Philippine Airlines' plan, the result was transformative. One lawyer involved trumpeted that the case resulted in a $2 billion reduction in debt, a streamlined fleet, and a strengthened balance sheet. In one fell swoop, Philippine Airlines' liabilities dropped sharply, its cost base improved, and it had money in the bank to reboot operations. The balance sheet was essentially rebooted, a rare opportunity for a legacy airline to start fresh financially. As Philippine Airlines' president put it at the time, this was a chance to emerge as a stronger airline and to rebuild for long-term growth. But how does this financial cleanup look on paper, and how does it compare to other airlines that didn't get such a tidy reset? To answer that, let's fast forward to 2025 and dig into some numbers. It's now 2025. Philippine Airlines has been out of bankruptcy for over 3 years. Travel demand has rebounded, and Philippine Airlines has been busy rebuilding its network. The most striking difference between Philippine Airlines and many of its rivals is visible in one place: the balance sheet. Philippine Airlines' financial position in 2025 is remarkably strong, especially for an airline. Let's paint a clear picture of the numbers. Philippine Airlines 2025. The airline's total debt and long-term financial obligations are about $1.39 billion as of mid-2025. That is down from $1.57 billion a year earlier, meaning Philippine Airlines has even paid off some of the modest debt it had after restructuring. It has cash reserves of roughly $455 million on hand and total assets around $3.8 billion. Crucially, Philippine Airlines' equity, assets minus liabilities, turned positive, about $922 million in shareholders' equity. In layman's terms, the company owns more than it owes, a healthy sign. This is a huge turnaround from the dark days of 2020 to 2021, when Philippine Airlines' equity was negative and it was technically insolvent. And Philippine Airlines is not just solvent, it's profitable. By mid-2025, the airline marked its 15th consecutive profitable quarter. In Q2 2025 alone, it earned $60 million net income. A string of quarterly profits has further strengthened the balance sheet, giving Philippine Airlines the confidence and cash flow to invest in growth. Thai Airways 2025. Compare this to Thai Airways, Thailand's flag carrier and a regional competitor. Thai Airways also went through a restructuring under Thai bankruptcy law, starting in 2020. While Thai did achieve a turnaround in operations, it's been making an operating profit each quarter since 2023. The debt overhang is still significant. As of 2025, Thai Airways has a debt obligation of around 190 billion baht, approximately $5.8 billion, remaining to creditors as part of its court-approved plan. It has paid back some already, 94 billion baht, but still owes roughly 96 billion baht to be paid over the next decade. In plain terms, Thai is carrying more than 4 times the debt that Philippine Airlines has, and it will be sending chunks of cash to old creditors until at least 2035. Even after its own exit from restructuring, Thai's balance sheet is weighed down by these liabilities. The Thai flag carrier also had to shrink drastically. It cut its workforce by half and trimmed its fleet during the restructuring. So while Thai Airways is no longer in bankruptcy, it doesn't have a truly clean slate. It's more like a heavily edited slate still bearing some old marks. Garuda Indonesia 2025. Indonesia's national airline, Garuda, provides another contrast. Garuda went through a court-supervised debt restructuring in late 2021 to 2022, dealing with an eye-popping $9.6 billion in liabilities at the start. The airline did negotiate haircuts, reductions, on what it owed. Some debt was converted into very long-term bonds or new equity. However, by 2025, Garuda still finds itself in a precarious position. In fact, as of early 2025, Garuda's balance sheet showed $1.4 billion more in debt than assets, essentially negative equity of $1.4 billion. The company is technically still insolvent on paper, even after its restructuring. It managed to briefly post profits in 2022 and 2023, but fell back to a net loss of about $70 million in 2024 and another $73 million loss in just the first quarter of 2025. Garuda is scrambling to fix its finances, even talking to Indonesia's sovereign wealth fund about a potential capital injection. Operationally, Garuda had to drastically shrink as well. It now flies around 84 aircraft, with many still inactive on the ground because it can't afford to operate or maintain them all. In short, Garuda did not get the kind of clean break that Philippine Airlines did. It's still heavily debt-laden and struggling to fully recover, making expansion capital-intensive and challenging. Singapore Airlines 2025. Even the region's star performer, Singapore Airlines, SIA, had to take on a huge financial burden during COVID-19, albeit of a different kind. SIA never filed for bankruptcy. Backed by Singapore's government investment arm Temasek, it raised an enormous rescue package to weather the pandemic. This included raising about 5.3 billion Singapore dollars in new equity and 9.7 billion Singapore dollars in mandatory convertible bonds, MCBs. Those MCBs are essentially debt that would convert to equity by 2030 if not repaid sooner. By design, they gave SIA breathing room without immediate repayment obligations. As travel rebounded, Singapore Airlines swung to record profits, over 2 billion Singapore dollars profit in fiscal year 2023/24, and began aggressively paying down those bonds early. By mid-2023, SIA had already redeemed 6.6 billion Singapore dollars of the approximately 9.7 billion Singapore dollars in bonds, about two-thirds, leaving roughly 3.1 billion Singapore dollars still outstanding. This is good progress, but consider that SIA essentially had to take on over $10 billion in new capital obligations and then use a lot of its recovery profits to pay them back. Singapore Airlines emerged from the crisis with a stronger competitive position in many ways, but financially it meant diluting shareholders and taking on future repayment commitments. The bottom line, even the best-in-class airline had to saddle itself with hefty obligations to survive the pandemic, obligations that, until fully paid or converted, hang over its balance sheet. In contrast, Philippine Airlines' obligations were largely wiped out. It didn't owe a bailout debt to the government or bondholders because it went the bankruptcy route. The differences are stark. Philippine Airlines in 2025 looks financially lean and fit, while many competitors are still in a post-COVID convalescence, carrying extra weight, debt, from the pandemic shock. A clean balance sheet isn't just a number. It means Philippine Airlines has lower interest expenses, more cash to invest, and more credibility to order new planes or open new routes. Let's delve into how Philippine Airlines is using this advantage strategically. Emerging from bankruptcy with minimal debt turned out to be a strategic masterstroke for Philippine Airlines. Freed from the albatross of interest payments and past due bills, Philippine Airlines could finally play offense instead of defense. By 2025, the airline is leveraging its healthy finances to do things that a couple of years ago would have seemed impossible. Here's how Philippine Airlines' clean slate is fueling its expansion and outpacing rivals: fleet modernization and aircraft orders. Perhaps the biggest headline of Philippine Airlines' resurgence is its shopping spree for new airplanes. In May 2023, Philippine Airlines stunned observers by announcing plans to acquire 9 Airbus A350-1000 long-range jets, the largest variant of Airbus's modern wide-body family. These planes aren't cheap. Sticker price can be around $366 million each, yet Philippine Airlines is confidently placing orders. According to Philippine Airlines' chairman Lucio Tan, the first of these A350-1000 is scheduled to arrive in late 2025, with all 9 deliveries spread over the next few years. These A350-1000s will become the new flagships of Philippine Airlines' long-haul fleet, capable of non-stop flights from Manila to North America and perhaps even Europe. In addition, Philippine Airlines is buying 13 new Airbus A321neo jets for regional routes, with those deliveries starting in 2026. This is a massive investment in fleet renewal, 22 brand new aircraft in total over the coming years. For context, 22 new planes is roughly 1/3 of Philippine Airlines' current operational fleet. Such an aggressive refleeting plan would be unthinkable for an airline still crawling out of debt. But Philippine Airlines can do it because its balance sheet can support new financing, and its owners and creditors see a solid financial base. In fact, by the first half of 2025, Philippine Airlines had already spent 20.26 billion pesos, $363 million, on pre-delivery payments for the A350-1000 and 16.54 billion pesos, 297 million, on deposits for the A321neos. Those hefty down payments barely dented Philippine Airlines' finances. The airline generated enough cash from operations to cover $300 million in capital expenditures in the first half of 2025 without trouble. With little old debt to service, Philippine Airlines is channeling its cash into growth assets rather than interest payments. Meanwhile, some rivals, like Garuda or Thai, can't even reactivate all their grounded planes, let alone afford brand new ones, due to financial constraints. Network expansion and new routes. A young, fuel-efficient fleet is a means to an end, in this case, expanding Philippine Airlines' network. The airline's clean slate has enabled it to think ambitiously about routes and market share. Philippine Airlines is now planning non-stop services that were previously beyond reach. For example, the new A350-1000s are expected to boost flights to North America and could potentially open a non-stop Manila-New York route, something Philippine Airlines attempted with smaller A350-900s pre-pandemic but had to suspend. Philippine Airlines is also eyeing a return to Europe in the near future. With a more capable long-range fleet and a healthy balance sheet, relaunching flights to cities like Paris or London becomes a more tangible goal. Regionally, Philippine Airlines has been increasing frequencies and even adding new destinations. The airline resumed regular flights to mainland China in 2023 as borders reopened, ramped up flights to Australia, and even launched a historic new service to Tel Aviv, Israel, in 2022. By 2025, Philippine Airlines' network spans 4 continents again, and it proudly maintains it's the only airline linking the Philippines non-stop to places like the US East Coast and Toronto. All this expansion requires investment in marketing, in ground infrastructure, in staffing, and those investments are easier to make when you're not digging out of a financial hole. Philippine Airlines' competitors, in contrast, have had to be cautious. Thai Airways, for instance, has been talking about doubling its fleet in coming years, but it must do so carefully while meeting those restructuring repayment schedules. Garuda is focusing on domestic and regional core routes because it can't afford to adventure into low-yield long hauls right now. Philippine Airlines' advantage is that it can seize opportunities immediately as travel demand rebounds rather than first reallocating cash to pay old debts. Product upgrades and customer experience. Having a financial cushion also allows Philippine Airlines to invest in the customer experience, an area the airline had been lagging in before. As part of its post-Chapter 11 revamp, Philippine Airlines has been upgrading aircraft cabins, for example, retrofitting 18 of its existing A321ceo aircraft with new interiors, in-flight entertainment, and Wi-Fi by late 2025. It's pursuing digital transformation, rolling out improved online and app features, and enhancing its frequent flyer program. These improvements aren't just nice-to-haves. They are strategic moves to win back business travelers and overseas Filipinos who might have tried other airlines. By offering a better product, Philippine Airlines aims to capture a premium market segment. Crucially, it has the capital to do this. The airline's plan includes investment in a new cargo business too, converting some aircraft for all cargo flights to ride the air freight boom. Many Asian airlines in 2020 to 2021 talked of pivoting to cargo and digital, but Philippine Airlines is one of the few that actually had the balance sheet to allocate serious funds to these projects post-pandemic. Avoiding interest and finance costs. Let's talk about the less glamorous side of all this. Interest expense, the money paid to lenders. Before bankruptcy, Philippine Airlines was saddled with high interest costs on its debt and unpaid leases. Post-2021, a large chunk of that interest simply vanished, along with the $2 billion of debt that was written off. This saved Philippine Airlines tens of millions of dollars per year in expenses. We can think of it this way. If $2 billion in debt was eliminated and assuming an average interest rate of, say, 5%, That's about $100 million a year in interest that Philippine Airlines no longer pays. That $100 million can instead go to fund new aircraft leases or loans for the A350s, essentially trading old debt for new, growth-oriented debt, but on a much smaller base. Philippine Airlines' rivals don't have that luxury. Thai Airways, for example, still has to budget cash each year to pay down its remaining $5.8 billion owed, effectively limiting its ability to invest. Singapore Airlines, despite its strong cash generation, devoted a chunk of its record profits to early redeeming its COVID-era bonds, because they carried a cumulative 4 to 6% annual cost. Philippine Airlines, having offloaded its bad debt in court, doesn't have a legacy finance burden draining its earnings. This means higher net margins and more internal funds available for expansion. In business terms, Philippine Airlines' cost of capital is now lower. New lenders see a healthier company, so Philippine Airlines can borrow for new planes at reasonable rates, and it isn't stuck with usurious emergency loan rates from the crisis period.